Hi, and welcome to Leavitt Brothers tutorial on neutral rectangles. Neutral rectangles represent large periods of doubt and indecision. They're characterized by parallel trend lines as the forces of supply and demand are nearly equal. The pattern is typically large and takes several months and often more than a year to form. Neutral rectangles can form in trends, but their sheer size will often neutralize whatever momentum existed when the pattern first started to form. And when an extremely large pattern forms, one can never be sure which way it'll break until it actually happens. Rarely are any reliable clues given. A trader can only wait until the stock makes up its mind, then and only then should money be committed to a position. Breakouts to the upside follow the same guidelines as bullish rectangles. This is to say, a volume surge is needed and some separation from resistance helps increase the odds of success. Breakouts to the downside follow the same guidelines as bearish rectangles. This is to say, a delayed volume surge is preferred because a surge that occurs when support is broken can indicate capitulation. Also, some separation from the pattern is needed to confirm the move. There are two common ways a target is determined. 1. The move out of the pattern will match the height of the pattern. And 2. If the stock continues in the direction of the trend that existed prior to the rectangle forming, the move out of the pattern could match the move into the pattern. This could be measured from the far side of the pattern as shown here, or from the midpoint as shown here. The extent of a move will often depend on the overall market. A strong market will help a breakout to the upside, while a weak market will help a downside break. And of course, fighting the market trend carries great risk, so expectations need to be kept in check. Let's look at a couple of examples, but first a quick side note. Rectangles are difficult to play. Symmetrical triangles have converging trend lines and therefore must break by a certain day. But since rectangles have parallel trend lines and therefore theoretically can go on for many months, no time horizon is offered as to when the stock will most likely break. Here's Deere. The stock trended up most of 2003 and then traded into a 2-year rectangle. The pattern was so big and took so long to form, whatever positive sentiment existed when the pattern started to form was gone by the time the stock broke out. It really could have gone either way. In this case, it broke out to the upside, and it was a move to the midpoint of the pattern that identified where the stock would run out of upside energy. Here's Adobe. The stock doubled and then traded into a relatively fat rectangle pattern. Volume spiked when support was taken out. This isn't what we want to see, but we did get some separation soon after. In this case, the height of the pattern was too conservative in suggesting a place to take profits on a short trade. Here's RIM. The stock steadily trended up all of 2004 before trading into a 2-year 10-point rectangle pattern. Volume surged on the breakout. The move from the previous breakout at 7.5 to the midpoint of the pattern did a pretty good job identifying an area upside energy would run dry. That wraps up this tutorial. Again, neutral rectangles are similar to bullish and bearish rectangles, but are typically larger and therefore neutralize whatever sentiment existed prior to the pattern forming. Breaks to the upside should see a significant increase in volume, whereas breaks to the downside should ideally see a delayed volume surge.